Kylian Mbappé just signed one of the biggest contracts in sports history, and financial analysts say he might actually lose tens of millions of dollars because of it. The headline number is $305 million, but the real cash value, once you strip away the structure, is closer to $180 million. That gap doesn't happen by accident. Here's what nobody's saying out loud. The way his deal is built is almost identical to how most people negotiate their own salaries. And most people are losing the same game without ever knowing the rules. Mbappé's contract is heavily backloaded, meaning a massive portion of his money comes later. Deferred signing bonuses, performance clauses, loyalty payments that trigger years down the road. Sounds safe. Sounds smart even. But here's the trap. Money you receive in the future is worth less than money you receive today. That's not opinion. That's mathematics. Inflation erodes purchasing power every single year. €1,000,000 deferred 5 years at just 4% annual inflation is worth roughly $820,000 in today's terms. He's not getting $1 million. He's getting $820,000 wearing a million's clothes. But that's not even the strangest part. Deferred income creates a compounding tax problem that most people never see coming. When deferred payments land, they hit all at once, which can push you into the highest possible tax bracket for that year. You pay peak rate tax on money you earned across years of work, compressed into a single taxable moment. Spain's top marginal income tax rate sits above 47% for elite earners. So a deferred lump sum that looks like $50 million on paper can clear just $26 million after tax. And remember, inflation already ate into it before the taxman arrived. Now here's why this matters to you specifically. Because you're probably doing the exact same thing right now without realizing it. Annual bonuses, stock vesting schedules, pension contributions, deferred compensation plans. These are all versions of the same structure. Money you earn now, collected later, taxed in a lump, devalued by time. And here's the negotiation mistake that makes it worse. Most people anchor their entire conversation on the total package number, the headline figure, instead of the net present value of what they'll actually receive. Your employer knows this. HR departments are trained to make deferred compensation look generous on paper because it is cheaper for the company in real terms. They give you future dollars. You celebrate present dollars that don't exist. The smarter play, the one Mbappé's advisors should have pushed harder for, is front-loading. More cash now, less deferred, fewer performance clauses on money you've already earned. Money you hold today can compound. You invest it, it grows, it works for you. Money locked in a future clause just sits there losing value while your employer essentially gets an interest-free loan using your wages as collateral. There's also a risk layer most people ignore entirely. Deferred compensation is often unsecured. If the company, or in Mbappé's case the club, hits financial trouble before that payment triggers, you could lose it entirely. It happened to thousands of employees during the 2008 financial crisis. So what's the actual move? Before you accept any compensation package, ask for the net present value calculation. Discount every future payment at a realistic inflation rate. Then compare that real number to what you'd receive if all of it landed today. If the deferred structure costs you 20% in real terms, and it usually does, that's the number you negotiate around. Push for a higher base. Front-load bonuses. Minimize the gap between the moment you earn and the moment you receive. Mbappé's contract is a $100 million lesson in how the most impressive numbers can hide the most damaging structures. Your salary is probably doing the same thing on a smaller scale, and the math works against you just as ruthlessly. Subscribe if you want to keep learning how money actually works, not how they tell you it works. And tell me in the comments, does your current compensation include deferred payments? And did you ever run the real numbers on what they're actually worth?